Let's get more on these anticipated rate cuts. We're joined by Eric Lascelles, Chief Economist at RBC Global Asset Management. Great to see Eric, as ever. Thanks for coming into the studio as well.
My absolute pleasure.
What are you looking out for from the Bank of Canada in particular? I mean, you feel that there is going to be a rate cut.
I think so. I don't think it's too hotly debated at this point in time. I guess it's not quite fully priced, but it mostly is. So I think we can feel reasonably comfortable in suggesting that 25 basis point rate cut is on its way. It will be certainly interesting to see what kind of guidance is given for further down the road, because one thing I find interesting is that the market really doesn't have that much further cutting priced for the Bank of Canada. And you can, of course, say it's already done a lot of that. The overnight rate is already into the twos. But when you compare the scale of the economic damage and the amount of economic slack and this sort of thing to the level of rates, I think there's an argument that there's room for a fair amount of further easing, maybe a bit more than the market thinks. Probably not today, but perhaps spread over the next 6 months to a year.
It's one problem here, though. They cut interest rates. Will consumers just start bidding up houses and not really doing anything productive for the economy? I
mean, that's certainly been the story of the last 20 years or so. And so I'm sure they're very sensitive to that, as much as it's tricky to the extent it's not, of course, directly in the mandate. But to me, one of the reasons it's fairly straightforward to cut right now is because that's so much less of a risk than it has been for so long. You're starting from a housing market with a fairly weak footing. And so, of course, you're quite right that every rate cut, I'm sure, does activate that housing market to some extent. But I think you could do a certain amount of that before really you'd be worried about an overheating housing market. So to my mind, that's not really the break that it's been in the past.
I suppose another thing interest rates do is stimulate purchases of big goods, durable goods, insofar as people buy cars and have swimming pools on credit in many cases. Is that good for the economy?
Right. I mean, broadly speaking, it can be supportive. It tends to be broader than that as well. I mean, let's recognize interest rates from a consumer standpoint do a lot of what you're saying of the housing and the durable goods. From a business standpoint, an interest rate is a hurdle rate for an investment decision. And so lowering that hurdle rate is a helpful thing as well. One complicated element is, of course, so much of the weakness in Canada is exogenous right now. It's coming from tariffs. It's coming from a lack of demand for Canadian goods and this sort of thing. And of course, there's a great limit to the extent that interest rates can restore that, if that makes sense. But I think when you're looking at an unemployment rate in the 7s, which is where it is right now, an inflation rate that isn't too scandalously high, it's higher than that 1.9 once you deal with some of the carbon tax business, but nevertheless, it's not too high. It seems to me that with a neutral overnight rate as a starting point, you can get away with something. And so that's my expectation.
So we're at 2.75 on the base rate. And if there's predictions among some people that we'll get down to 2%. What would be the significance of that?
Yeah, I mean, certainly it would be a stimulative footing. And so here we are at a neutral place. It would take you to a stimulative place, not to an extraordinary degree. Of course, we've had policy rates that were down right into the zeros just about.
It's amazing to think.
Hard to imagine, and probably not going back there anytime soon. And some lessons have been learned in terms of inflation, but also asset markets and housing and that sort of thing. But to my mind, a 2% rate would be a reasonably stimulative setting, but not one that would be really endangering Canada from an asset market perspective or anything like that. I don't think it's a bad sort of number to target over the next 6 months to a year as the Bank of Canada lowers that rate.
But wouldn't that be essentially a zero interest rate, given that inflation is around 2% now?
Yeah, but I mean, let's recall we were in a negative, of course, we're talking real interest rates here. We've had negative real interest rates, you could argue, more often than not over quite a lengthy period of time. And so I would still say, yeah, it's for sure supportive, but it's not nearly as problematically supportive as in the past. And I guess the other angle is that, there is still some economic pain to come. We probably haven't quite seen the full height of the unemployment rate and that sort of thing. And the Bank of Canada wasn't in a great position to pull the trigger earlier in the spring because there was just so little clarity on what the tariff rate would be and how things would play out. And sadly, we still don't know how this USMCA portion will play out. But there's a clear sense that there has been some real damage done. And so that's why they can feel more comfortable, I think, acting now.
We've heard for years about this anemic investment by Canadian companies. Presumably that's a function of confidence, partly. What can be done there?
Right. Well, I mean, and it's been particularly bad recently. So the trade's been soft, of course. The capex has been soft as well. The consumer, curiously, has been actually not too bad. So maybe that argues against a rate cut. But nevertheless, the capex is also rate sensitive. So I mean, some of that is just that it's been a very difficult economic environment in Canada, and it's been difficult to get projects going and this sort of thing. And I would argue some of the policies that have been put forth at the federal level recently do perhaps create a more business-friendly environment. It does feel like business attitudes have improved on that front. pushing against that, though, is this fairly radical level of uncertainty over just what the access to the U.S. market will be. And so I think for the moment, that tariff and that U.S. relationship is the dominant theme, and so it's a challenging one. I do think if we can look beyond that, we probably shouldn't just yet, but if we look beyond that, you can argue perhaps things are lining up for a bit of a more friendly environment there, and perhaps some partial revival on that front.
This is a bigger question, I know, and it might be politically impossible. But if we move to a shift to increasing consumption taxes and cut income taxes, some economists say that's likely to stimulate investment, but politically difficult.
Yeah, that's right. And so certainly not on my bingo card as a likely outcome, though maybe I'm not as in touch with some of the rumors on Parliament Hill as I should be. But I mean, theoretically, that's right. You know, you do generally prefer a consumption tax-heavy tax structure because, precisely as you say, it doesn't discourage the kind of investing that we'd like to see happen. So in an ideal world, you'd see that. Of course, generally that's quite politically unpopular, and indeed voters were very keen to see the GST cut a number of years ago, and so I suspect that would be a difficult thing to deliver, but it would probably be economically efficient.
And just finally, Don Drummond, former TD economist, etc., he has argued that we have a system that favors a subsidy and tax system that favors small companies, but it's generally they're not research heavy, they're not exporters. Should we start saying to them, sorry, we're not going to favor you so much and favor big companies that can afford to do real innovation?
Yeah, I mean, it's such a difficult question because, of course, you know, from acorns grow mighty oaks, and so some of these small companies will become the giants of the future. But it is absolutely fair to say that small businesses are favored in the tax structure and this sort of thing. So that's quite true. I think it is equally true to say many of the big businesses are the innovators and are the companies that drive R&D. And so perhaps there's some rebalancing. I'd be inclined to think, though, it's less taking from small businesses and perhaps making it simply a more friendly environment for large businesses as well.
Eric, just finally, is there some phrase or word that you're looking out for Tiff Macklem today?
I don't think so. I'm going to take that whole press conference and see where we end up.
Thanks very much. Eric Lascelles, Chief Economist at RBC Global Asset Management.